2022 started off optimistically. The world was reopening as countries came to grips with the COVID-19 pandemic. But the war in Ukraine, inflation, rising interest rates, and fears of a recession have changed all of that. So what steps should investors take to navigate uncertain times? Joining me today, a panel of chief investment officers and experts, and I'm very proud to welcome them all. Beginning with Hou Wey Fook, who's Chief Investment Officer for Consumer Banking and Wealth Management at DBS. Hi, Wey Fook.
Hi.
Thank you for being here. Stefanie Holtze-Jen is also here with us, Chief Investment Officer for Asia Pacific at Deutsche Bank International. Hey, Stefanie.
Hello.
We've also got Robert St Clair, who's the strategist at Fullerton Fund Management.
Hello.
And Sani Hamid, Director of Wealth Management, Economy and Strategy at Financial Alliance. Welcome to Money Mind today. Let's start with you, Wey Fook. Just a quick question, and we get this discussion going. Will rising rates or raising interest rates rein in inflation?
Yeah, so if you look at it historically, that's the Federal Reserve's response to high inflation. So back in the 1970s, we had two oil shocks and inflation was very, very high. The then chairman, Paul Volcker, raised rates to really put a cap on inflation. I think the Fed's response this time around will not be dissimilar. So we would expect more rate rises to kind of slow down the demand and therefore inflation.
If the strategy doesn't work, Robert, what happens?
Yeah, well, one of the key dilemmas, I guess, is that a key component of the inflation that is high, of course, is the goods price inflation, and that's been affected by the high transport costs as well as the high oil prices. So the Fed is really hoping, along with the consensus, that as oil prices hopefully slip back a bit and are contained going forward, and we see some of the supply chain bottlenecks freeing up, the goods price inflation can come down. I think that where the key correction has to come through, and that might not be so sensitive to interest rates. I guess where the Fed's power is maybe to bring down the excess demand pressures and the wage inflation, which is also quite high at the same time.
Well, I guess this begs the question then, will there be a recession?
Yeah, so that is the obvious risk. If they were to hike too aggressively, you could trigger a hard landing. But given where the economy is now today, look at unemployment rate in US, it seems to me that the economy has legs, So it could be that it would be a slowdown rather than a hard landing, in my view, yeah.
Yeah, the problem is probabilities have shifted a little bit because, of course, number one, the track record of the Fed to be able to raise rates that aggressively in this kind of environment and to avoid a recession has not been too good. I think there's been 2 times that it was achieved. And the second part is, I think, that is the worrying right now, is the Fed itself. It's advising us that it will be very difficult to achieve a soft landing. So that's why I think the market has started to reprice. Not to say that I differ in terms of your expectation and that it would be more of a shallower recession, if at all.
These things are dynamic. They're not static. Things occur along the way. In the year 2000, when we had the dot-com bubble, it was very external. Markets were coming down, we had SARS, we had 9/11, we had the Iraqi war. So these are the external things which, if you bring it forward to now, it's the geopolitical uncertainties that lie ahead. In 2008, it was more internal. It was really an implosion within the system itself. And with that so high in the global system today, and with where we're going to, i.e. higher rates now, lower rates later, who's to say that we couldn't have some implosion in the system today? So I think, again, these things are very hard to call. If we have them, we're going to go into a recession, probably potentially even a deep one. If we don't have them, then maybe we can avoid them.
From the growth perspective, the fundamentals, the starting points are very strong because households have very strong balance sheets, corporates have high profitability. But of course, things have changed a lot with high inflation, high oil prices, and of course, markets have fallen a lot. Markets are really signalling that the recession is the more likely outcome, and that will have adverse wealth effects for households and firms. So I think at the moment, it's kind of a case that the market is maybe more pessimistic than the economists, but the economists are slowly revising up their probability of recession. So it's a 50-50 call, I think, at the moment.
Thank you. Stefanie, so Asian economies, how will they fare in this environment?
I'm actually much more optimistic, and I would actually group Asia in two, because China obviously is the most important part and driver for Asia, and has a very different story to the rest of all these economies we were talking about already, the G7, and then of course we have Southeast Asia. So COVID-19 has been ruling in China, and it will all depend on how the zero COVID strategy will be managed going forward. But Southeast Asia, for instance, has a reopening story. Also is not necessarily every country is negatively impacted by higher commodity prices. There are also positives.
For you, Sani, how do you suppose China will manage their economy now that there's a lot more freedom? I mean, the lockdowns are coming down. We don't know what the future of zero COVID is, but at present, second half of the year for China?
China's in a very unique position from the fact that they've undergone the correction that we're seeing now in the Western world. We've seen the bond markets collapse because of Evergrande. We've seen the stock markets collapse because of what's happened with regards to the tech sector, the education sector. So they've undergone that deflating of the so-called bubble on that side. And now we're seeing the government come in both on the monetary fiscal side. So it's kind of like a slightly different cycle compared to what we're going through with the rest of the world. So by and large, if you were to ask me the whole universe of equities, if there was one country which had this opportunity of going the other way, it probably would be China.
Yeah. Wei Fook, how do you suppose all these factors impact the way you invest for the second half of the year?
So the way we are kind of advocating for portfolios to be constructed is go for quality. So in the fixed income asset class, the investment grade, those rated between A and BBB are already offering you 4% and above. So we think that's a sweet spot, and really holding cash is no antidote to preserving purchasing power, right, given the rising inflation. So you need to put that to work. I think investment grade is a quality play in fixed income. And then in the equity space, go for quality companies, companies that demonstrate what we call moat characteristics, like intangible assets, strong brands, because they are the ones that are able to, I would say, be resilient against higher inflation. They can kind of pass down rising costs to the consumer and preserve their profit margin. So quality is the name of the game.